Hello. So I'm going to talk about foreign exchange today. For context, there are a ton of financial assets that you can invest in. For example, there's stocks, bonds, options, and real estate. Foreign exchange is one of these, and it holds a spot as one of the major investment sectors. So, what exactly is it? The basics span pips, lots, and leverage, so I'll cover those in this video. And I'll also explain how geopolitical, government status, and price spread are the major factors in the foreign exchange market. Okay, so that's our roadmap. Foreign exchange is the biggest financial market in the world. It's bigger than stocks and crypto, and the actual monetary value of the trading that goes on every day is $7 trillion in cash flow every single day. So it's a big market. Okay, so let's get into this. I have my whiteboard here. Okay, so Forex is foreign exchange. And the concept is very simple. You're trading one currency for another currency. An example of that is it is trading a US dollar for a euro. Okay, so that is one example. You've done this if you've traveled on an airline and exchanged money for a currency that belongs to a place that you're going to. But yeah, that is the core idea of what foreign exchange is. It is a global market, and it is a 24-hour market. So here where the stock market closes at 5 p.m. and it opens at 9:30 a.m., that isn't a thing. For foreign exchange, it's 24 hours. And the other thing to note is that unlike the stock market, where you buy stuff with money, you're sort of doing a trade here. Like, this is the place that you actually need to think about, like, the value of what you're giving as well. So you won't just be trading with US dollars necessarily. Like, sometimes you'll want to be trading with euros, any currency that you're working with. So give one currency for another. Okay. Very good. So I want to specifically talk about this example that I brought up earlier. The euro to the US dollar. And this is the most traded pair in the world. If you buy euro to US dollar, you're betting that the euro will strengthen against the dollar. So we don't really care about if they're both doing good. We don't care if they're both doing bad. Like, maybe Europe and the US both get into some sort of serious economic trouble. That doesn't matter for this. The important part for us is the relative strength of the euro to the dollar. So let's start with some numbers. Euro to US dollar let's say the exchange rate is 1.2000. So every single euro is worth 1.2000 US dollars. Okay, that's the number that we're working with. If you buy this, that means you think that this number is going to increase. So maybe you think that the euro should be worth twice a US dollar. Maybe you think it should be worth 5 times as much. If you buy this foreign exchange trade, that is what needs to happen for you to make money. And the reverse is true. If you sell this quantity, this exchange, you're betting that the dollar is going to increase relative to the euro. So you think that this number should be lower. Maybe you think that 1 euro should be worth exactly $1, or you think that maybe the dollar should be worth 2 euros. But yeah, that is the trade that you're making. Okay, so that is the basics. Let's go into what these strange words are: the pip, and the lot, and leverage. What are we talking about when we hear those things? Okay, so a pip stands for percentage in point. And what exactly does this mean? So I wrote this number up here, 1.2000. Well, a percentage in point is that last box there. Circle it in red. So it's 1/10,000th of a currency trade. And the reason that that's the case is because there are literally so many currencies. You can't talk about things going up in dollar values, because that literally, it doesn't make sense. So they have this like percentage notation, BIP, pips, and yeah, this is what it is. If something goes up 1/10,000th of percent, then it has moved 1 pip. Okay. So what if you're actually like trying to convert all of these pips into actual money? How do you do that? Well, that is where lot size comes in. Okay. So, but how much money is a pip? Okay, and that is where lot size. Okay, so weird name, but it's another really simple idea. It is the size of your trade. Foreign exchange trades in standardized sizes, so pip values are consistent. So we have like a common language to talk about any of these trades, and a standard. There are 3 main lot sizes. There's a standard, and that is 100,000 units of currency. There is a mini lot, which is 10,000 units of currency. And there's a micro lot, which is 1,000. So again, you can think about these as $100,000 for the standard lot, $10,000 for the mini lot, and $1,000 for the micro lot. And of course, you'll be trading them for 100,000, or you'll that's the base unit that you're trading, and the amount that you get back depends on the exchange rate. Okay. Okay, and we'll just get into actually converting your pip size to money real quick. Okay, so let's put some numbers to this. If you have one standard lot and your investment gains 5 pips, 5 pips, that translates to 100,000 units of currency times 0.0005, and you get a total of whatever currency you're using plus 50. So yeah, that's how you turn pips into your gains. Okay. To go into quick detail about the others, if you have a mini, you just scale that down by a factor of 10. So you have 10,000 times 0.0005. That's about 5 currency. And a micro is just 1,000 times 0.0005, and you earn about half of a currency. Okay, cool. So that's lots and that's pips and how to turn them into your gains. Okay, the last part about foreign exchange that's significant is leverage. So you may have noticed a problem that if you want to make 50 currency, $50, then you have to have $100,000 of capital. And a lot of people don't have that. So how are you supposed to make any sort of money at all in foreign exchange? Well, you do leverage, and that brokers give leverage rates. An example one is 50 to 1. So what this means is you can give your brokerage $1,000 and they will turn it that is worth, they'll let you trade with 50,000. And all of a sudden, this $1,000 on a 5 pip increase can earn half of what 100,000 earns. So you can actually start making tangible investment gains on foreign exchange due to leverage. Yeah, so that's great. You can get more buying power and more potential profit. But of course, you got to keep in mind that the reverse situation can go as well. So instead of losing half of a dollar on a $1,000 investment on a 5 pip loss, those losses are also exponentially more if you're utilizing your leverage. So you'd lose more money as well. So it increases risk. But it's very cool. It's an option so that you can actually see tangible changes in your account. Okay. So those are the basics. There's pips, there's lots, and there's leverage. Let me just run through one full foreign exchange trade example. Full example with all the information so that we can get a sense of what goes on during one of these trades. So you buy one mini lot of EUR USD at 1.1 exchange rate. Okay, so that's what you bought. The price moves up. This number is what you're looking at. The rate goes to increases to 1.1050. So if you remember, 1 pip is 1/10,000th. We just moved up 50 10,000ths of an exchange. So that is a 50 pip move. Great. So on a mini lot, so you have 1,000 times 0.0050. That comes to about $50. 50 units of currency. And since we're trading, we invested in euro to USD. Yeah, that's our profit. Okay. Of course, the reverse thing could have happened. So you could have invested 1,000 and you go down negative 50 pips. That's about minus $50. Okay, so this is all foreign exchange trading is at the core. You just use the information that you have to make an educated guess about the direction of that currency pair is going to move. Maybe a government is looking unstable and you want to bet against it. But yeah, if you size things appropriately and use leverage responsibly, all the other strategies, the indicators, the news events, all of that stuff is just the layers on top of this core trading strategy. Okay, so there are a few things that I want to mention before this video is over. I alluded to them at the beginning. And the first thing that I want to mention is um, how to make a strategy, how to make a trade that's actually going to make money. Because a lot of channels out there are just like bro science, just like looking at angles on the charts, and that stuff is not really, it's not really science. Like, I don't know, maybe there's some relationship between like social behavior and the way that a chart's going to move, or maybe they're figuring out the algorithmic trading strategy that some of the major banks are using, but there's no reason that any of that should be legit. So yeah, what is legit? What will make you money? Foreign exchange trading is basically governed by um, the strength of a currency, right? So if a government is up and coming and it's making strong moves in the geopolitical atmosphere, that will be a strong investment for foreign exchange. On the reverse side, if a government is failing and they're really unstable, their economy's falling apart, um, that is going to be a good target to bet against. Um, and it's, yeah, if you like to think about these types of politics, then foreign exchange is a good place to um, exercise your opinion. Um, your your investment is a communication to the rest of the world that um, this this ratio of currency values is wrong, and you think that it should go in a different direction. So perhaps an example is the US dollar versus um, Brazil. Okay, so if you invest in that trade, then you think that the US dollar should be more than it currently is compared to Brazilian money. So, yeah, if you're right and the world has priced it incorrectly, then you're going to make money. And if you're wrong and the world has it priced correctly, then, well, nothing too bad. But yeah, if you're wrong and Brazilian money should be worth more than it is in US dollars right now, that's where you pay the price. So yeah, that's sort of like the main influencer of foreign exchange. There's one more major market force that you should be keep track of, and that is sort of like what the banks take advantage of, and the exchanges take advantage of to make money. So they need to get paid for um, keeping this system in place where you have the ability to make all these trades. And one of the major ways that that happens is a spread. So if you go, this is just like a stock market or anything, the amount that people are actively selling something at is going to be higher than the amount that people are actively buying things are at. So if you instantly buy a lot of USD to Euro, it'll come in at maybe, if the average price is 1.2, maybe you'll buy it for a little bit higher, maybe 1.25. So you're paying a little bit extra. And when you try to sell it, if you want to sell it right away, then you're going to pay 0.15, a little bit less than the average market value. And you say like, hey, well, where's my money going? That's the nature of the exchange. These exchange rates are this is just like how the market operates. But yeah, it's a pain if you're trading, but that also leaves openings for scalping if you want to hold the risk and sell the difference. That's a strategy that you can use. But yeah, that is everything. Thank you for watching, and yeah, please watch my other YouTube videos. Thank you. Bye.